Okay, let me share my screen. Share. Okay, let me invite the other guys. Okay, just waiting for the guys to join. Just bear with me. I'm going to share my screen. So today we're going to focus on risk management. Okay, admit. Okay, let's see. Let's wait for. Let's see if Tsetselelo is joining. Okay, I'm just checking with Tsetselelo if he's joining. Okay, let's proceed. Recording is started. All right. Today we're going to focus on this subject here, risk management. This one is not too technical. It's more. There's a lot of. It's more theory based, but it is very important. Risk assessments. We do conduct them in cybersecurity. Okay, we're going to start here. The types of risks. Now, the question is, what is risk? Risk is something that can affect the company or the organization in a negative way, right? But we do have types of risks assessments. For example, when you drive a car, what are the risks that are out there? You could get into an accident, someone could hit your car, or you could get a puncture. Those are the risks. That's why we have car insurance, right? So we do have types of risks assessments. We're going to start with the first one, which is ad hoc risk assessment. So this risk is only conducted when it's needed or when the need arises, right? For instance, right now we do have AI platforms, ChatGPT, Cloud, and all these other platforms. So a lot of organizations, they have to make this ad hoc risk assessment. They have to check and see how the employees are using all these AI platforms. Are they uploading company sensitive data? So the companies have to assess that risk. So it's an ad hoc risk because it's something that came up just now. It's a requirement right now. When there was no AI platforms, this was not needed. And this ad hoc risk, it's something which can be maybe repeated. In this case of AI, it will be repeated maybe every year or maybe twice a year. All companies will have to conduct a risk assessment regarding AI because AI platforms are here to stay. They're not going anywhere. And this one, recurring risk assessment. This is a risk assessment that we conduct every now and then, meaning it could be every month or 3 times a year or maybe once every year. Examples of these are phishing emails. If you can check, I send you guys a practical exercise for phishing simulations. So phishing simulations, it's something which I conduct every month in the company. Every month I have to send out different phishing simulations. So that's a form of a recurring risk assessment. Penetration test, every company has to do this penetration testing. Penetration tests are basically where companies could get internal IT security or external, an external company to come and conduct a penetration test, basically to test their systems. To basically they'll pretend to be hackers and try to get through their system and see if they can access all the sensitive data. So that's what recurring risk assessment is all about. And in this one risk assessment, this one is conducted for a specific purpose and is not repeated. For example, when you are implementing a new software in a company, will conduct a one-time risk assessment for that particular software. Or when someone joins a company, here's another example. We do check their criminal records, right? We are assessing if they are a high risk or individual. But we only conduct that risk assessment only once. So we only check the criminal background just that one time. And then if it's clear, then they get hired, and then that's it. And this one, continuous risk assessment, this is a never ending assessment, so it never stops. So we do have these are monitoring systems that run continuously, like Microsoft Admin Center, security. So this runs continuously. Even this one. Let me go here. Microsoft Purview. If I can click there, then share screen. So this one also runs continuously. You can see it even shows you the insider risk management. And it shows the risk score. So yeah, that's what continuous risk assessment is all about. We use tools that run continuously on our systems to manage risk. Let's go. Here. Okay, I just want to share the screen. So if you look at question 1, based on what I've just shared, they're saying what type of risk assessment is conducted on a regular basis, monthly, annually, or annually. What kind of risk assessment is this one? Is it 1, 2, 3, or 4? Let's see. This one will be number 2, recurring. Because it happens on a regular basis, right? So it happens every month or it happens once every year, right? So, what are the first steps that you have to do when working with risk? First step is this one, risk identification, right? You have to identify the risk first. So, you need to recognize the thing that could cause negative impact to the organization's operations. And risk should be categorized based on impact and likelihood, right? So when you try and go get medical insurance, they do assess your health, right? They'll test your blood, your weight. They want to see, are you healthy? You drink alcohol every weekend, and then they'll charge you based on that, because they know that if you don't exercise and you eat unhealthy, there is a likelihood that you can get a heart attack or a lifestyle disease. So insurance companies and banks, they use a lot of risk management analysis. And then when it comes to risk, you have to look at the impact and likelihood and business impact analysis. Here, basically, you evaluate how the business will be impacted by the risk, right? So, will the risk stop us from selling products to our customers if we get impacted? Right. If you are Takealot, for example, you have a Black Friday special coming up, and then you know that there'll be a lot of people logging in at the same time. You have to assess the risk and check and see how many people can log in at the same time on your platform, right? You have to check, can 5,000 people, can 10,000 people log in, or can 20,000 people log in at the same time? If they all log in at the same time, maybe 20,000 people, will will that affect the website? Will it crash? Will it hang? And it will affect our ability to sell the products to customers. Then you know that that's a high risk, because it's disturbing or disrupting your main goal as a company, which is to sell products to customers. And then let's go to business impact analysis concepts. These are the three concepts which are used in business impact analysis. First one is RTO, recovery time objective. So basically, this one is about the maximum amount of time a system can be down before causing unacceptable damage to the business, right? For example, Takealot, when Black Friday comes along, what is the maximum amount of time um, can they allow for their system to be down, right? Because they know that if we stay down for too long, we will lose a lot of sales, we will lose a lot of customers, right? So maybe they might give themselves a time of, say, 30 minutes or 1 hour. They know that in that hour they will lose so many customers. But if they are down for more than an hour, if they're down for 2 hours, they know that they would have lost this much customers, right? So that's what this is about, recovery time objective. The maximum amount of time a system can be down before causing unacceptable damage to the business. So if a company sets an RTO of 4 hours, that means the business must be back online within 4 hours, right? And this one, RPO, recovery point objective. This one is about the maximum amount of data loss a business can tolerate, right? How much data are we willing to lose? That's what. So that's what this is about. So, how much data can you afford to lose? That's why it's important to have backups, right? If you're a company, you know that only one server You can afford only to lose one server. But if you lose 2 or 3, you know that your business is down heavily. So that's why it's very important to have backups. So if one server goes down, then you know that, okay, you have a backup in place and you'll get your data from the backup. So if you're a company that works with customers and then you don't have backup, your hard drive, you only have one hard drive or one server, and it crashes with all the data, with all the customer data, and you don't have backup, that means you cannot provide services to those customers. And if we move to this one, MTTR stands for mean time to repair. Mean time to repair. How long does it take to fix something when it breaks? And that's what it means here, mean time to repair. So when a car breaks down, how long does it take for a mechanic to fix it? So basically, it's the average time it takes to fix, diagnose, and repair a system that was down. So if FNB has a problem with their ATMs, they're all down, how long does it take for all those ATMs to be back? That's what this means, mean time to repair. And there's a way also to calculate it. If a server goes down 4 times in a month, and then normally when a server is down, it takes 8 hours to fix it, then the MTTR will be total of hours or total hours divided by the number of repairs. So this will be the calculation. It means the average time it takes to repair a server is this 2 hours. So all these calculations or all these methods are used in a lot of companies. This is how car service centers generate their costs in terms of charging people who are bringing their cars for services. And the next one is this one, mean time between failures, MTBF. Basically, this one just means how long does a system run before it fails? So basically, it measures the reliability of a system. And there's a calculation to it as well. So basically, if a server runs for 1000 hours and fails, let's say 5 times, then the MTBF will be this. Total operation time divided by the number of failures. So it means the server fails once every 2 hours or 200 hours, meaning the server runs for 200 hours, then it breaks down. They fix it, then it runs again for 200 hours, then it breaks down. Okay, let's go here. Okay. Let's go to question number 2. What does RTO stand for in business impact analysis? Is the number one risk time objective? Is number two recovery time objective? Is the number three repair time objective? Or is it number four response time objective? Correct answer will be recovery time objective. It's this one. Recovery time objective. Okay, here they're asking on number three, if a server goes down 4 times in a month and takes 8 hours total to fix, what is the MTTR? MTTR stands for mean time to repair. Yeah, that's the correct one. Okay, let's go down. Let's talk about this one, risk register. So what is this risk register? It's a documentation tool used in risk management, and it contains all the known risks, their impact, right, and how to manage them. It has all the information regarding the risks. It has information regarding the risk owner, risk score, the risk plan, risk description, the risk impact, the risk likelihood, and the risk level. So in Microsoft, the risk register is something like this. Let me open this. Microsoft Information Protection. This can be a risk register because it does give us, here's the risk score. It does give us a lot of information regarding risk. Let's go to Insider Risk Management. So in our case, this will be the risk register. So the first steps in doing a risk register identify the risk and the risk description. Let me go back to this screen here. I want to see what kind of risks are here. See, it shows that your posture score is 58%, which is derived from the current assessment. For better compliance, consider creating more assessments. So they're saying I must do more risks assessment. I'll click here. So this is where I can do assessments. And then here, this is where I can see the regulations, meaning the laws. So all of these are regulations. So depending on the kind of organization that I'm looking at or I'm working in. So every industry has its own kind of regulations, right? If I can click on this one is used. You can't see the screen. Let me see. Okay, let's go back. Can you see the screen now? Okay, hold on. Jerry, can you see the screen or no? Hmm. Okay, I'm gonna reshare. Now I'm gonna try and say stop and then reshare again. Then tell me if you can see the screen. Can you see now? Okay. Okay, cool. Yeah. Let me go back and then I'm gonna go here on regulations. Oh, you lost it again. Okay. Okay. So it's on and off. Okay. Okay. Yeah, I was just showing you the regulations section. These are the regulations that are available here on Microsoft platform that you'll use for a particular industry. So this depends on the company that you work for. If you work in a bank, you would use this. You'd make sure that the company complies with this regulation here, the first one here. So this PCI DSS, this stands for Payment Card Industry Data Security Standard. So the financial institutions, they have to comply with this regulation. And you use a platform like this, Microsoft Purview. Okay, I'm gonna go back. So this would be a risk register that you can use, Microsoft 365 platform. And you can see the risk impact on the risk register, whether it's a low risk, medium, or high risk. And you can see the likelihood of that risk happening based on the information that you get. And risk outcome, this is also the likelihood and the risk level. And also you can see the costs on the risk register of what is the financial impact of the risk. So the risk register will contain all this information. So in other companies, they just do a document, Microsoft Word or Excel document, which they complete manually. In other companies, they use platforms like Microsoft 365, or they use other systems. Okay, I'm going to move on to this one, Microsoft risk tolerance and risk acceptance. Basically, this one is it's about whether some other companies are going to have to make a decision to accept a risk because trying to fix that risk might cost a lot more than actually fixing the risk. So I'll give you an example. Let's say you have a problem with your window in your house and then you want to fix it. You consult with someone who can assist you. And then they do the calculations only to find out they're going to have to break the wall so that your window could close properly. And building a wall is going to cost you a lot more time and money and resources. So you're going to have to make a decision whether you'll accept that risk or you're going to spend more money and time and resources to try and install a new window. So that's what risk acceptance is all about. So organizations sometimes they assess the risk if they see that it's only a minimal risk and it's not going to harm the organization or the company, and then trying to fix it will cost a lot more money and time. Sometimes they just accept that risk. And this one, risk appetite, it means the amount of risk an organization is willing to take, basically. A lot of guys who are in investments, they talk a lot about risk appetite, meaning they're willing to take a higher risk in return of higher returns. And then this one, expansionary. When it comes to risk appetite, there's three different types of uh, risks. First one is this one, expansionary risk appetite. This is where a company is willing to take a higher risk to potentially have higher returns. A lot of smaller companies or startup companies, they do have this one, expansionary risk appetite, meaning they are willing to take a lot more risk because they want to grow and become bigger. And then this one, conservation risk appetite, it's when the organization takes less risks, even though it means less returns. So organizations that are big or large, a lot of them, they're not able to take risks like startup organizations, because when it comes to large organizations, there's shareholders, there's a lot of stakeholders, there's a lot of approval processes. So it's not easy to make decisions just like that when it comes to large companies. But when it comes to startup or smaller companies, it's easier to make decisions and it's easier to take higher risks. So this applies in investing as well. If some of you are investing or trading, the same thing applies. The higher risk, the potential for higher returns, but also there's a potential for higher loss. Right? And then there's neutral risk return. This is a balance between risk and returns. So it's somewhere in the middle between this one and this one. Okay, let's go back here. I'm going to share this with you. Question 4. What does RPO measure in risk management? There's measure number 1, the time needed to recover systems. Which one? Oh, you can't see. Okay. So what does RPO measure in risk management? Is it the time needed to recover systems, maximum amount of data loss a business can tolerate, a frequency of system failures, or the cost of system downtime? Remember, RPO stands for Recovery Point Objective. Okay, I'll give you the answer. Correct one is this one. Amount or the maximum amount of data loss a business can tolerate. So companies always need to have backup. Okay, maybe I need to close this live. Is it still not showing?
That's fine.
Mm. Okay, let me try like this. I'm gonna share like this. Share entire screen. Okay. All right. Then it works like that. Okay, cool. Okay. Now let's focus on this one. Key risk indicators. So this one basically is it provides early signals, right, of a potential risk. Basically provides early warnings regarding risks. In the weather department of South Africa, they use things like this or systems that have this key risk indicators for predicting the weather patterns. So in companies also they do use systems like these. When you try and take a car insurance, they will take information from you. They'll want to know, where do you stay? Do you have your car is parked in your garage? Where do you work? And they want to get all this information. If you have a tracker, they want to track all of that. And then they will use all that information to determine if you are a high risk. The banks, they also do the same thing. If you are looking for a loan from a bank, they do use key risk indicators to assess if you are a high risk individual, whether you'll pay back the money or not. So in IT or cybersecurity, this is also used to assess the impact and likelihood of risk happening, so that we can take proactive steps, right? We don't wait for the risk to happen. And then there's also a risk owner. And all this information is found in the risk register. Risk owner is the person responsible for managing the risk and ensuring that, ensuring that there's mediation steps uh, are there to prevent the risk from happening. So, for instance, if there's risk of phishing in a company, because I do the phishing simulations, I'll be the risk owner in a company. I have to assess the phishing, if there'll be phishing in our company, based on the reports that I generate from the phishing simulations. And when it comes to risks analysis, there's different types. There's qualitative risk analysis and there's quantitative. What's the difference? Qualitative risk analysis, this one is based on likelihood and impact. It's subjective. Basically, it's based on an opinion. It's not based on numbers or numerical facts. For instance, if somebody says, "I think it's going to rain tomorrow," so that's an opinion. That's subjective. They're not basing that on stats or numbers. But this one, qualitative risk analysis, is analysis that uses numerical methods to estimate impact and likelihood of the risk. So this one uses numbers and stats. For instance, if somebody measures, if the weather services they measure the clouds, they normally take drones or they use those hot air balloons to measure the clouds, and then they can see that okay, there'll be rain, and then they release a statement that okay, there'll be 40% chance of rain. So that's what quantitative risk analysis is. So it's based on numerical methods. So a lot of companies in the insurance and banking sector, they work on this quantitative. They want to quantify the numbers. And they use different kinds of calculations to calculate that. First one is this one, SLE, single loss expectancy. Basically, this one is how much you expect to lose each time a risk takes place. All right. If a server, let's say worth 50,000, could be damaged, maybe 40% of the server could be damaged by a fire. Then what is that loss? What is that um, calculation? What is 40% of this 50,000? That's the loss. So insurance companies, they use a lot of this when they calculate how much your car is worth, how long have you been driving it. It's and then when you get into an accident, your car gets damaged. Then they can write off the car based on how much it's worth. Okay, let's go back here. Okay, this one, I'm gonna give you the answer on this one. It's gonna be this. So basically, they take 1,000, they divided by 5. Yeah, take 1,000 divided by 5. That's how they're able to get this MTBF. Okay, what is the first step in creating a risk register? What is the first step? Calculate financial. Yeah, identify the risk is the first step. Then this one, what type of risk appetite involves taking higher risks for potentially higher returns? Yeah, for startup companies, small companies, they use that one. For people who want to gamble, they also Folia. And people who trade currencies and forex. What are the key risk indicators used for? Key risk indicators to calculate finances, to provide early warning signs of potential risk, to determine. Yeah, it's this one. And this one, number 9, which type of risk analysis uses subjective assessments like low, medium, and high? Remember, subjective is based on opinion. It's not numerical or stats. Yeah, it's this one, qualitative. Okay, let me go back here. Let me see if we have enough time. Okay, 8 minutes. Let's see. Okay, this one is also used in quantitative risks to calculate. ARO, annualized rate of occurrence. It just means the estimated frequency of risk event. That means the risk that you're expecting to take place in a year, right? For instance, if you live in an area that gets thunderstorms or tornadoes, you expect tornadoes to happen twice in that year. So that's what this means here. This one, ALO, annualized loss expectancy. Basically, the expected yearly loss from a risk, right? So this one, in order to get a calculation and answer for this one, calculates SLE and ARO. It calculates these first two. And then they're able to get. So all of these, they're used by insurance companies and a lot of financial institutions. They use all these formulas. So in IT, we also do use, or in cybersecurity. So we need to know if the business comes to a standstill because systems are down, how much are we going to lose? Or if we get hacked through phishing, what's the expected downtime? And then this one, exposure factor, is the proportion of asset value lost if a specific risk happens, right? A 60% damage to an asset. So let's say a product is worth 1,000 and it loses 50% or it gets damaged 50%. That means the lost value would have been 500, right? Because 50% of this is 500. Let's go back here. So, what does SLE stand for in quantitative risk analysis? The system loss expectancy, single loss expectancy, security loss estimation, or standard loss evaluation. Yeah. So remember I told you this one, they get it by multiplying. How is ALE calculated in quantitative risk analysis? Yes. And then what does ARO represent in risk calculations? Remember I gave an example regarding tornadoes or thunderstorms. Is it one, annual risk outcome, two, annualized rate of occurrence or average risk objective, or this one, asset? Yeah, it's this one. In this one, which type of risk assessment never stops and uses tools like a SIEM? Do you guys know what this is? SIEM. Okay, let me open a window. I'm going to show you what that is. Splunk. Okay, let me go to Microsoft. And I'll come here. Okay, you can see here, get your SIEM, SIEM. This stands for Security Incident Event Management. Remember, on a single PC, we use Event Viewer to see logs, right? But in companies, in corporations, we don't use Event Viewer. We use this SIEM, SIEM. I just need to get a license for this. But there's a free one that we can use, but it's limited. It's only a trial. Okay, that's fine. I'll have to show you some other time. Do you know what this is? SOC. Have you ever? Yeah. Mhm. Mhm. If you are applying to be a SOC analyst, they will expect you to know. Oh my God. Okay. Let me do this. Okay, I'm gonna stop the recording here.